good afternoon, everyone. I'm Matthew Greco. I am the events manager here at PSS Life University. Thanks for joining us this afternoon. We're very pleased to have Anthea Perkinson, who's done many events for us here at PSS Life University. And today she's going to talk about tax saving ideas for New Yorkers. As you know, Anthea is a certified financial planner, and she's also an adjunct professor at Baruch College and the founder of Monterey Associates. Please put any questions or comments you have into the chat, and Anthea will answer it after her presentation. And with that, I'll hand it over to her.
Great, thank you very much. So I'm very pleased to be with you today to talk about this topic, tax savings for older adults, adult homeowners in New York. The usual disclaimer, this is for educational purposes only. It's not specific advice for your individual situation. Very straightforward agenda. I have spent the past month or so attending continuing education classes for tax preparers on the new tax law. So I'm going to share with you the key features for people over age 65. And we'll talk a bit about adjusted gross income, why it's important and how to manage it. Very important term. What SHE is, Senior Citizen Housing Exemption. It's a very important program in New York State. We'll talk about it, how it's impacted by the new tax law, and the new application and the renewal process, and how those are impacted by HR 1. I'm going to present SHE in the form of 2 case studies, and then we'll conclude with a little bit about the STAR school tax exemption program, just because so many people are unaware of it and are not registered to receive that credit. So key tax terminology. You probably know these terms. I'm not speaking to my undergraduate students here, but understanding tax filer status so that I'll toggle between single, married filing jointly. We'll talk about tax brackets, which is the range of income subject to a particular percentage tax. The difference between standard and itemized deductions, very material to the new tax code. Income tax versus estate tax versus gift tax. We'll give just a quick nod to those. Then we'll talk about tax credits, refundable and non-refundable. Inflation index, which looms large in this new tax code. Numbers are going to change every year based on inflation, which is not something that we've seen under, for example, the Tax Cut and Jobs Act. Exemptions, we're all familiar with that term. Exemptions are basically, it's an out-of-date term. Instead, we have a new term that we'll see quite a lot under HR 1, income phase out. All right, so giving you a quick image and overview for how the IRS 1040 tax form flows. If you ever listen to a tax preparer or a tax strategist, maybe you've listened to them on Bloomberg or at the New York Public Library, they will talk about above the line adjustments and below the line adjustments. And essentially what they are identifying are different areas where you can impact your bottom line tax bill. Above the line refers to the process of tallying up your gross income from all sources and then adjusting it. Some adjustments are subtractions. For example, if you make a contribution to a traditional IRA, that is an adjustment where you subtract from your gross income. If you have a little side business and you fill out a Schedule C and you have net income, that becomes an adjustment that adds to your reported income on the 2-page 1040. So after you've made either plus or minus adjustments to your year's income, you reach adjusted gross income. Super important term to know and to understand, is very different from taxable income. And adjusted gross income, if you wanted to look at it for yourself, it's line 11 on your 2024 tax form. Once we get to adjusted gross income, that is when we take either the standard or itemized deductions. We're going to go through that a little bit as we talk about the new tax law, only after you make that deduction do you have your taxable income. Once you have taxable income, now you apply it to brackets to figure out what your tax bill is going to be. So if you remember the Tax Cut and Jobs Act, when it was introduced in 2017, went into effect 2018, it was radically different from what came before. It introduced many new tax brackets. So we went from about 4 to 6. The rates were adjusted. And it also, interestingly, introduced much higher standard deduction amounts. If you remember back in time, the standard deduction was a fairly modest dollar amount, but all of us would claim exemptions, personal exemption for ourselves, a spouse, dependents, and this helped us sort of increase the standard deduction amount. It was standard deduction plus exemptions. That no longer exists. These exemptions are gone. The other new element introduced was the cap on state and local taxes. That's what SALT stands for. State and local taxes are capped at $10,000. And so if you happen to pay more than that in your tax bills to New York State or New York City, well, tough luck. You could only deduct $10,000 maximum. It also introduced a cap on deductible mortgage interest. Your mortgage had to be less than $750,000, the balance for your mortgage interest to be deductible. Introduced qualified business income, which you can kind of think about as like a standard deduction for small businesses. More changes in 2019 when they adjusted the alternative minimum tax schedule. And then COVID-related changes were introduced in both 2020 and 2021. So that's the background. Now let's talk about H.R. 1. That's the formal name for this bill as passed. It's referred to as the One Big Beautiful Bill Act. But here's what's interesting. These higher standard deduction amounts are described now as permanent. Permanent being a relative term. New administration can come in and put their own stamp on the tax code. For a single individual, $15,750 is the new standard deduction. It's been adjusted for inflation. And for married filing jointly, $31,500. The new tax brackets, this whole slew of them, are now again permanent. There is a new feature for reported tips, not terribly material to our audience here today. Same thing for qualified overtime pay. These are bells and whistles. There are a lot of stipulations and restrictions on both of these. Same thing for the new ability to deduct loan interest for the purchase of new cars. Now, what's interesting is that there is a temporary increase in the cap on state and local taxes. It went from $10,000 to now $40,000. There's a new estate and gift tax exemption set at $15 million for single filers, $300 million for joint filers. This is obviously upending, really impacting estate planning, because most estates are not going to hit these thresholds. So some of the strategies used are not going to be so popular. New phase out of itemized deductions. This is new, where if you take itemized deductions, and many high income individuals or households do, there are some phase outs based on income. But for us here today, the big great news is an additional $6,000 above the line deduction for filers age 65 and over. And remember, above the line means that it reduces adjusted gross income. There are income phase outs for all of or most of these new features. So for the state and local taxes, if you're looking to itemize and to deduct $40,000, this is great. But you have to know that the income threshold in order to do that is $500,000. Interesting, it's both $500,000 for single filers and for married filing jointly. So if you have more than $500,000 in income, there is a reduction. And effectively what happens is, depending on how much higher than 500,000, you're pushed back to a $10,000 deduction. The new senior deduction is also subject to an income phase out. It's going to be available in for tax years 2025 through 2028. So we have 3 happy years for tax returns that we can take advantage of this. So we do have to consider it temporary, and there is no certainty that it will be renewed off into the future. Again, it is above the line, lowers adjusted gross income. The income phase out begins at modified adjusted gross income of $75,000 for single filers and $150,000 for married filing jointly. And it's sort of a 6% decline, and the deduction is fully phased out, meaning unavailable, once a single filer hits modified adjusted gross income of $175,000 or $250,000 for married filing joint filers. Here's something very interesting. While they added that $6,000 special deduction above the line, they didn't take out the bonus deduction for those who take the standard. So the over age 65. So if you're a single individual, your standard deduction is $15,500. If you're over age 65, you get another $1,600. So your actual standard deduction is $17,100, which is pretty good. If you're married, it's twice that. So your $31,500 becomes $34,700. So very generous to senior tax payers. Here again, just a repeat of some repeals that are made permanent. No more personal exemptions. Home equity debt interest, which used to be deductible if you used a home equity line of credit or home equity loan to improve your property, you could deduct the interest. No more. Same thing with moving expenses. That was, they made this change under the Tax Cut and Jobs Act, and that remains in place. Unless you're in the military, there's no deduction for moving. Other things that were made permanent, the mortgage interest deduction for balances less than $750. And this last one, which really gets my goat, because I think this is very unfair, personal theft and casualty loss, only if declared a federal or state disaster. And why this gets my ire going is that the biggest target of identity thieves and fraudsters are seniors. We have bank fraud, we have wire fraud, we have crypto scams, romance scams, all of this. And it used to be that while you were probably never likely to be made whole after suffering such a theft, a loss, you could at least get some relief by claiming this on your income taxes. And that is no longer the case. So I think that's something that should come back. Charitable contribution deductions. This is an interesting one. Starting in 2026, so not this year, but next year, individuals who do not itemize, so you're taking the standard deduction, can deduct below the line charitable contributions made in cash during the tax year. So there's an annual max for $1,000 of cash contributions if you're single, $2,000 if you're married filing jointly. For itemizers, we have a hurdle. We're familiar, for example, with the hurdle for deductible medical expenses, which have to be greater than 7.5% of your adjusted gross income. Well, under this new tax code starting in 2026, your charitable contributions have to be higher than 0.5% of your adjusted gross income. So not everything that you contribute will be fully deductible. This is encouraging a lot of people to make donations this year when they will be fully deductible. This is just a quick image of what the tax brackets look like. So you can see in both dollar spans what is taxed at what rate. So this is for 2025. You can see that these are not evenly spaced. Some brackets cover larger amounts of money, and we do have a very high 37% for those who have taxable income above $751,000. Here are the single rates down here, and here's the Medicare tax. Here, remember, under our tax code, the long-term capital gains and qualified dividends are subject to different tax rates. We have a 0% tax rate if the income for the individual is below $48,350. Some of the capital gains that would be part of their taxable income could be taxed at 0. Most people are going to fall into the 15% tax bracket, which is why when you hear people talking about capital gains taxes, that's the tax bracket they refer to, or the rate that they refer to most often. Just a reminder, when you see the pumpkins, it's time to remember tax loss harvesting, the opportunity to sell underwater investments to offset either distributed or realized long-term capital gains. If you have more losses than gains this year, unlikely, but if you did, you can use these losses to offset up to $3,000 of ordinary income. And ordinary income refers to wages, pension payments, Social Security, dividends, and interest. Other strategies for reducing taxable income, specifically or most likely for those who are taking required minimum distributions. That is when most people start to complain about their tax bills, because at the point you are taking RMDs from your qualified accounts, your 401k plan, your traditional IRAs, SEP IRAs, there are very few places to hide from the tax man. And just about every source of income at that stage in life is subject to income tax, federal income tax in particular. But you do have the opportunity to shelter some of your RMD, potentially all of it to certain AGI limits, through what's called a qualified charitable distribution. Any taxpayer over age 70 and a half can directly distribute up to $108,000 from the IRA, from the qualified account, to a qualified 501c3 charity in 2025. This distribution, either in part or in full, to satisfy an RMD, will satisfy an RMD, but the amount will not be counted as taxable income. Now, here's the stipulation. The QCD transaction has to be the first distribution of the year in order to satisfy the RMD and not be counted as taxable income. This means if you have, for example, waited to take any money out of your IRA, plan to do it maybe next week, and you want to take part in a QCD, when you called for help with this, you specifically say, I'm doing a qualified charitable distribution first. Here's the charity I want that money sent to, and then we'll talk about the rest of my RMD obligation. This is a quirk in the IRS tax code. So just remember, it has to be the first money out of the qualified account in the tax year in order not to be counted as taxable income. Another opportunity, and this is a longer term type of strategy, for people who have significant amounts of money in their retirement accounts, a good problem to have, but as you see RMDs on the horizon, as you see how your tax bill is going to go up significantly over time, you may want to consider moving some of that money. The amount, the cap is $210,000, that would be transferred from your IRA into a qualified lifetime annuity contract. And the premise behind this is that money is no longer going to be in your qualified retirement account, no longer in your IRA, subject to RMD withdrawal obligations. It will be moved over into this deferred annuity. You set it up, say, in your late 60s, and your idea is I'm going to defer taking income from this annuity as long as possible. The maximum age is 85, then you have to turn it on. What this does is two things. You've avoided some of the RMD up front. You've also created longevity insurance. Now that you've turned this amount of money into a lifetime annuity, you can't outlive that. If you live to 105, you'll continue getting your checks once you turn this on for as long as you are around. So it's helpful near term in terms of lowering RMD obligations. It also solves for that outliving your money concern. They can be structured to continue payments to a spouse after you die. And the later you hold it, the later you expect to turn on the money, the higher your actual income payment will be when it begins. Remember that once you are taking this income, it is fully taxable to you. So you have deferred the RMD. Not really completely escaped it because this will be taxed as ordinary taxable income. Another quick reminder on the IRS 1040 flow. Gross income from all sources plus or minus adjustments to income gets us to adjusted gross income. Then we take adjusted gross income. We subtract either the standard deduction or itemized deduction. Then we have taxable income to apply to the tax brackets. Now, AGI, super important term to understand. So for all taxpayers, your eligibility for the earned income tax credit depends on your AGI. Same thing for Roth IRA contributions, Medicaid eligibility, New York State of Health premium reduction tax credits. Lots of federal income-based benefits are keyed to AGI. Student loan income-based repayment options keyed to AGI. For us, significant here in New York State, eligibility for the senior citizen housing exemption is based on your AGI. What is SHE? It's local governments and school districts in New York State can opt to grant a reduction in the amount of property taxes paid by qualifying seniors by reducing the taxable assessment of seniors' homes by as much as 50%. And thing to note here is that this is based on the taxpayer. It's not something that becomes a permanent record for the property. A lot of people have the concern, well, if I reduce the assessed value, what happens if I leave my property to my heirs or if I want to sell it? It's not attached to the property. It belongs to the taxpayer. Who can benefit from the SHE program? New York State home residents, age 65 plus, with income below, adjusted gross income below $58,399. In New York City, you apply by March 15th to receive a property tax reduction effective July 1. Now in 2026, that falls on a Sunday or a Saturday. So you actually have until March 17th to make your application. Owner-occupied houses, condos, and co-ops are all eligible for this statewide benefit. Here's what it looks like. So again, they use income brackets. If you have adjusted gross income off your federal tax return between $57,500 and $58,399, you could have your assessed value reduced by 5%, which will nominally lower your tax bill. And you can see as your income gets lower and lower, so start thinking about strategies for lowering your adjusted gross income. You could get all the way to the point where you have less than $50,000 in income, in which case the value of your property is reduced by 50%, which is a pretty significant potential reduction in your property taxes. In New York City, there were major changes made to the program in 2023, really made it a lot easier to navigate, to explain, and to properly apply for. Prior to 2023, a lot of people made mistakes on filling out the application. So, and part of that was the way they defined income. It didn't sync with adjusted gross income. It had very little relationship to your IRS 1040 definition of income. And so people would make mistakes and have their applications kicked back or denied, or they would get less of a benefit than they thought. So now the program uses a federal adjusted gross income from the IRS 1040 as the starting income. Only taxable Social Security is included. Now, on the former application, the whole thing had to be put in, and people would make a mistake and just take the number off their tax return. Tax-exempt interest is not included in income. The tax assessor subtracts all taxable withdrawals from IRAs, whether these are for required minimum distributions or just periodic withdrawals that somebody might take. Provided it was taxable, it is backed out of adjusted gross income. This is pretty significant for a lot of older New Yorkers. For many people, particularly as you pass the age of 75, 78, and there's sort of a bell curve distribution on the RMDs, it gets higher and higher and higher. Backing that out really reduces your adjusted gross income. Now, this is slightly changed in light of the new One Big Beautiful Bill Act. If you're already in the program and you're simply renewing your application, which has to be done every 2 years, you get to subtract out-of-pocket medical expenses. So if you were in before 2024, I think it was July of 2024, this still applies. For new applicants, this is sort of going away. Here's what the income calculation worksheet looks like. And you can tell just from the number of lines where they indicate NA, how confusing the old application used to be. So all you need to do is look at the applicable tax return, 2024 or 2025. We'll talk about that more in a minute. And plunk that AGI number right here. Down here, you can write in how much of that AGI was made up of taxable distributions from qualified accounts, IRAs, 401ks, 403bs. And once you make that subtraction, then you have your adjusted gross income for purposes of SHE application. Now, for new SHE applications due on March 17, 2026, New York City residents, because this benefit varies depending on what county you're in. In New York City, you can use either your 2024 federal tax return, if that happened to be a nice low income year for you, or you can hurry and get your 2025 federal tax return completed in order to submit it by March 17th. Why might you want to do the 2025? Well, if you're eligible for that senior $6,000 special deduction, above the line deduction, that could really help more people qualify for a bigger reduction under SHE. So it's going to be tight. And I say that because one of the things I'm learning as I attend all of these IRS continuing education classes is that they are scrambling to redesign the applicable forms. Now, every year they modify the 1040. This year, they are also modifying the Schedule 1. They're introducing a Schedule 1A where individuals over age 65 are going to claim that $6,000 above the line deduction. So they have to create the form, they have to test the form, program the form, and then make it publicly available. They are obligated to have this all ready and done by January 21st, same date that anybody who gets a W-2 by law has to have it available to them. So it means that you've got a window between, say, January 22nd and March 17 to get that done so that you can use it for your SHE application. Other New York State residents, if you're outside New York City, in the 5 boroughs, check your local taxing authority website, and they will indicate how do they calculate income. It can be a little bit different. And just remember, as you look at the form and the reference to FAGI, that just means federal adjusted gross income coming off your IRS 1040. Okay. This is the instruction page for renewing. This is the new and renewal application for SHE. And here you see the references to local option by taxing jurisdiction. That's by municipality, school district, and county can be variations. So I'm very focused here on talking about New York City in particular. All of this exists online. If you Google New York State SHE, you can pull this up, you can look at it along with the other documents that I've scanned into the presentation. And I have this at the back. This is the renewal program or renewal application. And here for those people who are renewing, you can add up your unreimbursed medical and prescription drug expenses, and worth looking into if you're already in the program. So one of the best ways to understand changes in the tax code and how this flows through is to look at a case study. Those of you who've heard my presentation on SHE before, and we were just talking about the 2023 changes, might remember Lucy, who is age 68, so she's eligible for SHE. She's been in her condo for 32 years, doesn't have a mortgage anymore. Their condo fee has gone up by quite a lot. With higher food and utility bills, she's got high cost prescriptions, she's feeling squeezed. Is she eligible for SHE? So her sources of income in 2025, she has a modest pension, she has Social Security retirement benefits, and periodically when she needs a little money, she just takes a withdrawal out of her 403B plan. So here's what her calculation would look like. Here's how we get to her federal adjusted gross income. So we tally up her sources of income for the year, which add up to $68,300. We take the $6,000 special deduction to reduce her gross income to adjusted gross income of $62,300. Over here, we get to net out for SHE her 403B withdrawal. It's fully taxable to her, so it is one that can be subtracted to give her SHE income of $54,300. So according to the schedule we looked at before, she could qualify for 25% reduction in her condo's assessed value, which would lower her tax bill. We may remember Charlie from our earlier presentation. Charlie has been in the SHE program, and he has been working and concerned about running out of money. He's age 76, still lives in a small single-family home in Queens that he shared with his late wife. He could use some updates, but he saves most of the money he's forced to take out of his IRA for RMD requirements. He's just being very cautious. He and his wife have been in the SHE program for a few years, but he's not sure his renewal application will be approved because he's recognizing that I've got a job, I've got Social Security benefits, I'm taking money out for RMDs, I don't have any deductible medical expenses, and his IRA keeps growing, which is a good problem to have. He's invested largely in the S&P 500 index, which has gone up dramatically over the past couple of years. So let's see his calculation. His federal adjusted gross income, well, he's got the W-2 earned income of $26,000. He's got taxable Social Security of $36,000, taxable RMD withdrawals of $18,210. So he's got $80,000. He doesn't think he is in the game anymore. We take his new for senior $6,000 above the line deduction, and his adjusted gross income is $74,350. So what do we do next? Well, first over here, we take that adjusted gross income, we back out the RMD withdrawal. Then, because he's a renewal, he gets to deduct his out-of-pocket medical expenses, which we've identified here. He's got Part B, he's got Part D, he's got Medigap. So after doing all of this, his adjusted gross income, which is not in the game for she, is now $51,556, and he would qualify for a 40% reduction in his home's assessed value. We can do a little more tax planning and help Charlie out a bit more. Remember that under the Secure Act of 2017, they moved the date when RMDs started. Remember, it used to be for everybody age 70 and a half, and that was made later. It was phased in. First it was 73, then it's 75, depending on your birth year. They also removed the age limit on making pre-tax traditional IRA contributions. So if you're working at age 80, you could literally make an traditional IRA contribution. It sounds a little crazy because on one side of the ledger, you'll be taking money out to satisfy RMDs, but on the other, you could be putting money in for a pre-tax deduction. So that's Charlie's situation. He's got the W-2 earned income. That's what you need. You have to have earned income. You can't do this based on Social Security. He takes the deduction. He makes a full $8,000 IRA contribution. Remember, he's not even spending his RMDs. So he's got money starting to build up in his checking account. So he's got it to throw into a traditional IRA, which would reduce his federal adjusted gross income to $66,350. Now, when you take this AGI and you back out the RMD money, $18,210, and his out-of-pocket medical, now his adjusted number is $43,056. Well below the $50,000 to qualify for a 50% reduction in his home's value. So he should definitely make this IRA contribution, renew his SHE, and benefit from the reduction in his tax bill. Quick couple of notes on STAR. And I bring this up simply because I'm irritated how many people are unaware of this program. This is very separate from SHE, which is property taxes. This is a New York State school tax relief program, and it provides an exemption on a portion of school property taxes or a rebate check for owner-occupied residences. And it doesn't apply to property taxes, counties, town, or city, except in the cities of New York, Rochester, Yonkers, and Syracuse. And the same types of property are eligible. There are two types of STAR exemptions. Basic STAR, and all you have to do is sign up on your county's website to be in STAR. For enhanced STAR, you have to be age 65 or older. You get a little bit more money back. There is an income benefit or an income limitation. If you make more than $107,300 AGI, you won't get the benefit, but then you also wouldn't be eligible for SHE either. Okay. For everybody else, no age limitation. If you make less than $500,000, you get the STAR credit. Okay. There is a STAR credit and a STAR exemption, and they use adjusted gross income for the 2024 tax form. Remember, it's line 11, minus taxable portions of IRA distributions. So it works similar to SHE, where they back that out. So if your income maybe, if you qualify for SHE, you should also qualify for STAR, and don't forget to sign up. It's not automatic. You might have been in it forever. The regular STAR, they don't automatically make you eligible for the enhanced STAR. You have to reapply. So since 2016, STAR has been available either as an exemption or a credit. The exemption subtracts the value from your school tax bill. So you see it when you get the tax bill. The credit, which is more popular, you actually get a check from New York State. The dollar amount of the exemption or credit will depend on your school district. Since 2016, all new homeowners who register for STAR get the STAR credit. So they're receiving checks. New York State estimates that the 2025 tax reduction per household will be $290 for basic STAR and $650 for enhanced STAR. Depends on your school district. Our check was for $1,200, so it can vary. The application is usually March 1, but seniors may be able to shift to enhanced STAR after March 1. In summary, don't forget that your new and renewal applications are due by March 15th, and they have an online application that is preferred over the paper application. The shift to AGI, less taxable IRA withdrawals and distributions and out-of-pocket medical costs. You may be eligible if you are simply renewing. This could be very beneficial. Use your IRS, actually this should say 2024 to apply for SHE, or if you did not, you can use your 2025, but you have to get it done in that window between January 21 and March 17. And if you use the 2025, you could benefit from the new $6,000 per person senior deduction. Okay. SHE reduces the assessed value of the senior's home, which will reduce the property bill. And remember that many senior homeowners are also eligible for STAR to reduce school or other county taxes. Okay. Here's some resources. I'll make this presentation available afterwards, so you can refer to these. These are all direct links to the New York State websites where the applications are housed, where updates and instructions are housed. And if all else fails, if you're in New York City, you can just call 311 and they will direct you where you need to go. Okay. So now I'll take questions that you may have entered in the chat.
Anthea, this is kind of a general question. There's a lot of information here, and maybe you can't speak to this, but I mean, is the average accountant going to be aware of all these changes?
Alas, no. But what I have found is that New York City's Department for the Aging is a great resource, and those people keep up with these types of changes and are good about referring people to the Department of Finance, where they have, I don't know what you call them, they're not counselors, but they have people who can help you navigate these forms and will help you properly prepare and submit your application.
Okay, good to know. I mean, because it sounds like people could be leaving a lot of money on the table.
Yes, it frustrates me that, for example, a lot of real estate brokers talk about the STAR tax exemption and then don't provide any information, and the homeowners move in, forget all about it, and
Yeah,
years go by when they could have had this benefit, which,
yeah,
for some people would be meaningful.
yeah, yeah.
So I see there's some things in. Okay. Question. Did the capital gains tax bracket change in the new law? And the answer is the brackets were adjusted for inflation, but the rates have not changed. So not really. Most capital gains, up to a little over $500,000 in capital gains are going to fall into the 15% bracket. Next question. Can you have both SHE and STAR benefits? Yes, you can have both because they're different programs and they apply to different types of tax. If you have two homes that you use 6 months each per year, can you get SHE at New York City House and STAR in another home in New York outside the city? Do they need to be for the same home? There is a stipulation for STAR that it's your primary residence. And I think the same is true for SHE. So you'd probably want to get them both for the same home, whichever one you use on your tax return as your primary residence. So Medicare premiums can be deducted from income for SHE. Medicare premiums, if you are renewing, so if you've been in the program since before 2024, that continues. For new people, if you're just applying this year in 2020 for the 2026 benefit, they're no longer deducting medical expenses, so Medicare premiums wouldn't count.
Anthea, did I see correctly or hear you correctly that for the STAR program, if you're married, both people in the marriage need to be over 65?
So, yes. Well, it depends. For enhanced STAR, yes. For regular STAR, no.
Okay.
So you can collect basic STAR. There's no age on that one.
Okay.
And the only exception, if one person is in a nursing care facility, they count that as still living at home.
Okay.
Okay, can you apply for SHE if you are in a nursing home and your home is empty? I believe the answer to that is yes. There is exemption for people who are in care facilities.
I've heard that overall that the One Big Beautiful Bill is not that popular with the public, but what you've raised today is that there actually are a lot of benefits, at least in terms of New York City or New York homeowning or adults.
Yes, for that segment of the population, this is a benefit. Now, the $6,000 above the line deduction is sort of in lieu of not taxing Social Security benefits. So for some people, this is going to be better because their Social Security benefits weren't that big anyway. For some people, this is not as good. But because we have these two programs, SHE and STAR, we do make out. I doubt that was the administration's intent, but we're going to run with it.
Sounds good. Sounds good.
All right. Another question. What about if one person is under 65 and the other is 65 and own the home? How does the tax benefits get calculated? So if they're married and filing jointly, on the application, when you look, there are places where you indicate whether the other occupant is a sibling, a non-relative, a spouse. There is some adjustment to that. This might be a little too technical for me to answer completely. I would encourage you to talk to the SHE representatives at the Department of Finance. You can, there is a benefit. I'm just not sure whether, how to properly guide you on that one. How were you able to confirm that we can use our 2025 tax returns if we file in 2026? The website now states this.
Thank you very much, and thank you all for attending. Please continue to look at our website for upcoming events. I'm sure Anthea will be back, and we have other legal and financial, as well as arts, culture, and health-related events. So take care, everyone. Thanks again, Anthea, and we'll see you all next time.